Okay, hi everybody. You've probably already saw the title. Thanks for coming. I was working furiously the last hour to get everything together. No, it's definitely an interesting subject for sure. It's a timely subject too, and it's something that I wish I would have had the time to sit in on what the other presenters did. I would have liked to seen their take on it. Correlations in intermarket interference, very important for us. Correlations, obviously the relationships between different markets. Intermarket interference would be if markets are giving signals at the same time. A lot of times, one market's giving a buy, and more times than not, if all the markets are giving a buy, then the buy signals are going to be a little bit more powerful. On the other hand, if some markets are giving a buy signal and other markets aren't giving that signal yet, a lot of times you're going to be better off waiting for the markets to interfere together. Interference is a term, and we'll cover that too. And that's what it is. It's interference. If they're not interfering and they're both going off at the same time, you're going to get bigger moves. Same story with trending markets too. If the correlations are tight and the markets are trending, different markets are trending in one direction, you're going to get bigger moves. As those correlations break down, you'll start to see what we call intermarket interference, such as the Aussies trying to go up, but the Euro's going down, or what we saw the last month or so, the Aussies trying to go lower, but the Euro's still pulling up. So you don't get big price movement in that environment. You could stay in that type of environment for a long time too. So as I said, it's a timely subject and one we're pretty familiar with too. As always, we need to remind you trading is a risky endeavor and not suitable for all investors. Compliance would be happy for me that I remember to get this slide in at the last minute. You guys may have heard me typing there right after I said hello. I'm like, whoops, we have to have a disclaimer. And there it is. Whoops. Let me try that again. There it is. Market environment. This is what we're going to cover. Leading indicator markets and strength and weakness. That's really what it is. It's strength. Leading indicator markets, they're very important for us. That's when you have tight correlations and there's generally going to be a leader, such as the U.S. stock market, such as the Aussie, such as the Euro. There's always generally going to be always generally, that doesn't sound right. There generally is going to be a market that's going to tend to be leading the pack, and that is a trend of itself too. We always want to focus on, we want to know who is the leading indicator, and that's really leading indicator markets. How you determine which is the leading indicator is strength and weakness. That's how you determine who the winners and who the laggards are. Also, positive and negative interference for trade selection. That's what we're going to show you today too. Positive interference is when the markets are all giving signals together. For example, the Euro, the Aussie, gold, the U.S. stock market. They're all giving buy signals at once. Odds are that if those signals work out, you're going to get them. The markets are going to move a little further, maybe even a little faster, if they're all given the signal at the same time. Likewise, if gold's a buy but the Euro's a sell and the Aussie doesn't know what to do and the U.S. stock market is a bull, as it always is, and they're tangled up, you're going to have negative interference. So positive interference when everything's moving together, even when they're changing direction together. That's positive interference. Negative interference when they're not. They're all tangled up. Essentially, they're counter trend, and that's a function of market environment that you need to be aware of. Leading indicator markets. It's really extremely important to know who the leader, who the laggard is. 1 second. Let me find my notes here. Here we go. In trading, just as in horse racing, you need to know who are the leading markets and which are the laggards. I think the comparison is a fair one here between the horse race, because let's face it, that's really what it is. Particularly when you consider how often beginning traders make the mistake of buying a market because it's cheap, or worse, selling a market because they perceive it to be expensive. I don't even want to say beginning traders. Experienced traders have done that too. I've been lured into that too, buying a market just because you think it's so cheap it can't go down anymore, or likewise selling a market because it's rallied so much that you think, oh, it's got to come down. Well, that's actually the opposite of how we need to think of things. we can't trade because we perceive something's expensive. You really have to take into account momentum too, right? And look at it this way. Buying something because you think it's really, really cheap and it's got to go up, that's like betting on the horse that's the last horse coming around the pole, right? So you want to be focusing on that leading indicator market, and you want to focus on the strong ones, know who the weak ones are. The one in yellow, that's right, Arvin. Very good, sir. Hey, hi, you guys. There, I see the chat now. I didn't see you guys. Hey, good to see everybody. Good to see you. Sal, Danji Versani, there's a good name. And Arvin and Boyke. All right. No, we'll get to that. Interference is created by the correlations. So leading indicator markets, very important. You don't want to be betting on the last horse, right? Or you don't want to be shorting the one in yellow either. They'll do that too. So it's better to stay away from the long shots. It's better to stay away from that seductive risk-reward ratio. Same with horse racing, and stick on the horse that had a pretty good outing in the last couple of outings. He was in the money. The odds are better he'll be in the money again if he's already found in the money. But you don't bet on a guy because he keeps coming in last because he's due. Same story with markets and horse racing. Leading indicator markets. For a market to be influential enough to be a leading indicator market, it needs to be widely held and heavily traded. Okay, that's the bottom line. You want a market that's widely held and heavily traded. People, they're looking around, they want their own little personalized little market that they think they're going to get a feel for. Well, if no one else is trading that market, believe me, the people that are trading it are going to take your money. Okay, if there's only a few people trading it, they're the ones that are going to make the money. Philip James, the best probability to buy the first rising bottom. Well, yeah, he's buying a higher low, right? You got to have a higher low. There's got to be some pattern there. You wouldn't just buy it to buy it because it's cheap. You got to wait for that first higher low, right? But this is very important for a market to be influential enough. It has to be a leading indicator market. It has to be widely held and heavily traded, and it's pretty easy to determine why we have Well, first, which markets are the leading indicator markets and why they are. Definitely the S&P 500, definitely the Aussie, definitely a leading indicator market. Even the Euro. The Euro becomes a leading indicator market by default because there's so many traders in it. But your true leading indicator market is going to be an asset class market, and I'm going to tell you why. Markets are heavily traded because investors invest in, investors and savers are going to put money into markets that have a yield, that have an asset class component to them, that give you ownership on a regular basis. Investors, savers are going to regularly put their 401k or their other retirement, whatever your investment plan is, you're generally going to deploy that. You're going to save money every time you get paid, right? Every time people get paid, they're looking to save money, or in the case of a lot of people, invest money. Now, I'm going to introduce you to a character. His name is William. We can call him William the Fractal. William is a pretty lucky guy. Meet William, the 24-year-old Fractal. He's a 24-year-old engineer who lives in a two-bedroom apartment next to a golf course in Chicago, in a Chicago suburb. Even better, he doesn't have to worry so much about crime. He lives in the suburbs. He works for an energy company that has interest in a Canadian oil outlet in St. Louis. Yeah, there is a big Canadian pipeline into the U.S., and the hub is, one of the hubs are St. Louis, where they put it onto the river, etc., in barges, of course. And they also own interest in a wind farms in Illinois and Iowa. So William's got a pretty good job. He makes about $68,000 a year, William. William is typical of the other students in his advanced engineering classes at the University of Illinois or Northwestern or Caltech. What makes him typical of many young people today who worked hard in school and were fortunate enough to get a good job in today's economy, right? So William is a fractal in that he is typical of his particular demographic, kind of a geeky kid, engineering student, did well, more than 4 years of college. Now he's an engineer in a pretty good, he's got a good deal going, right? So that's William. William is going to help you understand why we have leading indicator markets, why people choose who are the people that make these choices to put money in this market and that market that essentially creates those relationships and eventually those correlations. William is not unlike people his age group, and I think you guys got that. I was making that point. He's not unlike people in his age groups in other cities around the world. There are Williams in London and Paris and Perth and Toronto and San Paulo and everywhere. Everywhere there's Williams, there's young professionals, and they're making a little bit of money, and they're also going to save a portion of that money. Actually, on average, they tend to save around 16%. And why you say 16%? Well, a lot of times 12% is the maximum you could put in a 401k, and your company will match up to 6% for that first 10%. So that means basically girls are going to save the maximum. They're going to save 18%, and guys tend to save between 15 and 16%. Girls always save more than guys. So of all these people, all these young people that are making good money, and all the people that came before them too, by the way, all those different age groups, that's how they tend to invest, and that's how they tend to deploy their money. So it's very important to know why markets become well, it's very easy to understand why markets become leading indicator markets, because there's a lot of money coming in there. So every time William gets paid, or all those other Williams, and all the Williams in all the other different demographics, the Williams in their 50s or 40s or 30s, our William happens to be in his 20s, they're all getting paid around the same time, right? So there's a good amount of money in good times and bad times going into investment-grade markets, such as stock indices, such as carry currencies. So a lot of money going into these markets from these people, right? So William, or any other 20-year-old something who's just entering the workforce, is a fractal, because the fractal, if you guys recall, the fractal is that base component, that base pattern that when replicated creates a larger, much more complex pattern. This kid, William, is a fractal. He's typical of what the generation before him did. He's typical of what his generation is going to do now, and he's even typical of what the generation that comes after him is going to do. He's going to save as much of his money as he can, especially when he got that match from the company. So you can imagine the payrolls of the S&P 500, all those companies coming in every 2 weeks. Well, that money coming out of there has got to go somewhere, right? And it's going to go into asset class markets. It's going to go into the biggest leading indicator market right now is your current alpha market, the S&P 500. The S&P 500, look at that. It just keeps going higher and higher, right? Oh, you got Boyke had some people have some notes. Are you related? No. I do have a nephew though who is no, I'm not related to William. I do have a nephew. He's a little bit quirky, but he's got the engineering degree and everything. But he's probably he may go Air Force. But they're all over the place, these kids. And people will say, well, there's no jobs out there. Well, that's true. There's not as many jobs as there used to, but there'll always be Williams, right? Those geeky kids that, hey, they work hard, they get good jobs, they're going to put their money in the markets. And it is kids like that, and it's in every generation, too, people who work regularly, they're building a nest egg, but the most important thing is they have a cash flow. They have money coming in every 2 weeks that they have to deploy, and they end up deploying it in markets such as the S&P 500, which, it's 500, some of the better companies in the world, and it gives you ownership. And when you're William, when you're that young, what do you hope for in a market? When you're that young, you hope the market does this. You love it every time that market goes down, because you're going to dollar cost average. You're going to buy more. You're going to buy the same amount at whatever level. So all things being equal, you'd rather be buying it here than here, right? You'd rather be buying it here than there. But if you just keep buying it the whole way, 30 years from now, you're going to have a pretty good nest egg, right? Even if you started buying here, but you bought the same amount every time, when it gets up here, you still have a lot of money, right? And if you're young enough, you don't have to worry about all that. So this is what makes strong markets strong markets. And so that's why it's important that you understand this is how markets are. This is how markets move. They didn't design stock indices to go down. They really didn't design currencies to go down either. The currencies they're supposed to be competitive, but it's not as though they're going to go to zero, right? That's a pretty big move. That's a complete 50% retracement of the entire move. But if you're William and you started making your 68 G's in '09 and you got your 6% raise every year and you continue to put money in there, that's working for you. And yeah, no kidding. I'm sorry there. It's kind of understatement. Yes, it's an uptrend. So leading indicator markets are really opening the door for us to understand buy strength, sell weakness. This is a tenet in trading. We're not here to tell you what not to do, but we are here to tell you what to do, and that's why I love to break things down so simply. It's easy to tell people what not to do, and you can waste a lot of time with that. So I like getting right to the point. Amateurs often do the opposite of this, though. You may not make it all the way as far as you want to go as a trader because this kind of goes against your value system, buy strength, sell weakness. This is not kitchen table advice. Kitchen table advice is be patient, buy it low, and sell it high. Well, that really doesn't work anymore. You got to buy high, sell higher, sell low, sell lower. Buy strength and sell weakness is absolutely essential if you're going to get it right. So I don't want to belabor the point that most people don't get this out of the gate, that they do the opposite. So we're not going to stand that. But the way to ensure that you're going to do this, the way to ensure that you're buying strength and selling weakness is going to be keeping it simple. Look for buy signals following higher lows. That's how you buy strength. Sell weakness. Look for sell signals following lower highs. Now, if you're wondering where I was going with the William the Fractal, you understand that that's a lot of money coming into these markets every 2 weeks when young professionals, middle-aged professionals, old professionals get paid, right? When people get paid every 2 weeks, the 88% of the population that is working, and believe me, markets pay more attention to the 88% that are working than otherwise, or whatever it breaks down to. Markets always pay more attention to where people who do work deploy their paycheck. They're not as concerned about the people that don't have income. So that's why we want to focus on those markets where all the money's going into, because those are going to be pretty good trading vehicles for us. Added benefit, we don't have to worry about them basically collapsing overnight because we have a pretty good idea there's inflow to them coming on. We have a good idea that 10 years from now you'll be able to get some money out of that vehicle, right? Here's some leading indicator markets, and this is great. I put this chart up here. I was given another lesson, and I made this chart back in February. And you could see the S&P 500 on the left, the Aussie on the middle, and Euro on the right. It's a Goldilocks chart, right? I mean, the S&Ps are up over 8% year to date. The Australian dollar's up over 4.5% year to date. Even the Euro was up a little bit there, almost 3.5% year to date. Well, that was back in February, and that's how they were lined here. And I'm just pointing out why these correlations are that they are, because essentially once they get set, once the money's flowing, it's like turning around the proverbial barge, right? Ocean tanker, right? It takes an ocean tanker a long time to reverse, just like it takes a market to reverse. Well, there's a pretty good reason for that. There's money flowing into these guys on a regular basis. So what's fascinating is if you look at the S&P chart right now, it's up sharply on the year. I think it's up, 14% or something like that. The Aussie dollar is up a hair on the year, and the Euro dollar is down a hair on the year. So the Aussie dollar is a little bit, it's up like 40 pips on the year. The Euro's down, about 60, 70 pips on the year. So the trend that was set back in February is still essentially the same trend. The order of these markets, the strength, that this one's up the most, this one's up a little bit, this one's down actually. But the order didn't change. So that's what we mean. They're leading indicator markets for a pretty good reason. Chuck, FX Tough 101. How about this buy and hold? That's well, you can, if you have money and you make money, there's nothing with buying and holding. There's nothing wrong with buying and holding. But again, you have to have money so that you can weather a storm, and you have to make money so that you can buy markets on the cheap. Dollar cost averaging will always be dollar cost averaging. They'll always teach that in the finest schools too. It's different if you have to make money. Like when I was a young man, I had to throw the dice. The only way I was going to get ahead was to throw the dice, right? I did not. I never had that luxury of making money and having money, right? I was always trying to figure out how to make a nickel into a dime. But in the long run, though, buy and hold is it's a smart way to go. And that's, you have to think like people that have money and make money, and then you'll start to understand markets much better. You'll stop getting mad when you see a bad economic number and you see the market going up. You'll realize the market doesn't. Those people that have money don't really follow. They don't read much news anyway. They're too busy working, right? They're working and getting paid, and they're going to figure out how to deploy the money. But this back to thank you for FX Tough 101 for contributing. But back to the leading indicator analogy, the S&P's interesting. The S&P's how many 7-8 months later, 8-9 months later, the relationships are the same. The SPOOs are still the strongest, the Aussie second strongest, the Euro the least strongest. So leading indicator market's good to know. Oh, look, I put little arrows on there too. Very good. And the S&P is the strongest there. Here I'm going to make a comparison. Leading indicator markets, S&P on the left, Aussie dollar on the right, and I put that 66 level. And 66 for no other reason than they find this. This is an interesting experiment you do for people. If you give them $1 or give them $10, I'll give them $10 because this is we're not kids anymore. If I give you $10 and I say, okay, you can bet on the outcome of one of these occurrences, okay? You're not going to know the outcome. It's going to take 5-10 minutes for the outcome to turn out. So, but you can, if at any point you start losing money, you could say out. I'll take the money. Okay. So it starts at 10. It can go both up and down. You can lose the 10 that you have, or you can make more money. Right. Now, if I give you the 10 and it starts going down, it'll go down about a half before you'll start sweating it, because half is half. You're still going to get half of the 10. You're still going to get a 5. But once it starts going below 5, it goes below 50%. Right around when it gets about $3.33, or you get $3 and change, most people go, I'm out. I'll take the money, because $3 and change is better than nothing, right? They'll never right around that 2/3, right around when they're down about 33 cents on the dollar left. That's generally about when things turn around and you see things go the other way. So it's just human nature. There's something about that 2/3 level. So we put the 2/3 level on there for no other reason than it's 2/3. Now the S&Ps are on the left here, and the Aussie dollar's on the right here. Now we know, we just showed you before, the slide before, where the S&Ps were definitely higher on. That was back in February, and this chart is an intraday chart in February, by the way. So we just showed you here. Let me back it up. This is February. The S&Ps were up 8.5%. The Aussie was up 4.5%. Come back now. Here's the intraday chart. Same time, S&P, Aussie dollar. Now, if you take this buy signal right here, that's just a change of direction. You had a double bottom on that 2/3. You had to change direction. If you took that signal, you made 2.2%. Good trade. Same story. Same mark or similar market, same level. There's the buy signal there. We wait for the change of direction. Guys, hopefully you know what a change of direction is, or it's just basically you closed above the high of the previous candle. So you change direction. This trade in Aussie only netted 1%. This is the advantage of the leading indicator market. It's going to go up stronger. So don't ever think that you're buying something because it's cheap. Don't be afraid about buying something that's already strong. Look at, you would have made twice as much money speculating long the S&Ps than you did long the Aussie. My point being, because you were in the strong market. So it's that same theme as the horse race. You don't want to bet on the horse that's in the middle of the pack or at the end of the pack. You want to bet on the lead horse. You want to bet on the strongest horse. Now, why is that? Very likely it is that the S&Ps tend to be so strong and not as strong as the Aussie, because 401k, more people know about putting their money in the S&Ps than they do in the Aussie just yet. But they will learn. I mean, they'll come around. They'll figure it out that there's there's ETFs out there, and I'm sure, I don't know if you can have Forex. You probably can have Forex in an IRA, but it'll get to the point where you will see American workers will have broader exposure to the Australian dollar in a couple of years than they have in the past. I mean, it's just that's how it'll go. Well, as long as the Aussie has an advantage in the yield, but that Aussie yield may not be there for much longer too. So we'll have to see. But the lesson here is the leading indicator market. You were better off on February 1st, taking the buy signal in the strong market than the second strong market. You still made good. No one's going to complain about that trade. It's a nice trade, but you could have made more in the S&Ps. So you always want to go with the leading indicator. And I'm not sure where I'm going. It's the same chart, same story. Again, the S&Ps was the winner, I guess is the point there. Another easy way to see who is the strongest and who's the weakest, and this is going to help you as an intraday trader too, shorter-term trader. Here's a quote board. Now, I think they have a quote board on MetaTrader. I apologize, I couldn't dig one out, but a quote board just shows the net change on the day of the different pairs. And this is from my eSignal quote board. I have the net percentage too on the day. So Aussie dollar's up, it's up 15 pips. Wow, Euro's down 57 pips. That must have been earlier in the year because it's the opposite lately. And the S&Ps they're down pretty good too. So the Euro and the S&Ps are down. Australian dollar's up. Therefore, the Australian dollar is the strongest one, and the euro is the weakest one. I have a percent-wise too. It's down 0.43, and that one's up 0.14. So that's good information to have, and I'll show you how you're going to use that now. Here's a couple of charts. Australian dollar on the left and the euro on the right. And what was the story on the quote board? The Aussie was a strong one. The euro was the weak one, right? So when you get the opportunity to buy a dip, when you get buy signals, and here I just marked theirs. I marked that 66% too because that's such a funny number because do it time and time again. When the individual they're given, they can take the $10 or they can try to double it, but they're not going to lose it all. If the price starts going down, they can exit at any time. They always exit at that 33 cents. Pretty funny. So that's why we marked that level there. And it had to be a 50%. So that's a 2/3 retracement of the previous move. Here's a 50% retracement of the previous move. Euro here on the right, Aussie on the left. All things being equal, you get the signal. Well, you make a lot more. The market goes a lot further. You make a lot more pips long the strong one compared to long the weak one. Very basic observation, right? We all know that, right? It's amazing. I caught myself the other day. I was short the one that wasn't the weakest, and I ended up scratching my trade. I can't even remember what market I was in. I was short the euro when I should have been short the Aussie, and I didn't make any money. But if all I had to do was be short the weakest one, and somehow I outsmarted myself. But it's a basic lesson in trading: sell weakness, buy strength, and I had it backwards that time, so it happens. Donji Versani. Equities normally tend to be more by large amount both ways. Yeah, it'd be hard to lose. I mean, all things being equal, we use stops too. I mean, we teach money management. We're very good at money management. Overall, currencies are a great vehicle to trade. There is individual stocks. You're absolutely right. You're absolutely right, Donji, because individual stock you can get killed. If you're long an individual stock, you can come in and be down 50%. It's not likely you'd come in long the Aussie and be down 50%. So you're all right. That's why I like currencies. You have that non-systemic risk component to them. That's very important. Mr. Zaba. In this example, we knew what was. We looked at the quote board. The Aussie was up 15. The euro was down 57. So all things being equal, when we had buy signals, we took it in the stronger pair. This is at the beginning of the day. So we went long, at the time of the trade, the Aussie was stronger, the euro was weaker, so we keyed on the stronger one. Notice also the Aussie on the left put in a double bottom. Here you had a double bottom. And the euro was still making lower lows, so that's a big tip-off too. You're still making lower lows here. This is at the same time, by the way. The signals went at the same time. Oh, I should have a. There we go. Double bottom versus still making lower lows. So that's going to be a big time. That's where we're just bringing in price pattern. Always price pattern is going to assist us. So you had a better pattern there too. So the Aussie was much less weaker than the euro that day. So when eventually the buy signals came, and by the way, markets, regardless of the market, they all tend to give buy and sell signals at the same time. They may not, one may not go as far as the other. One may give a counter trend while one's giving a trend move, but markets still give signals all at the same time. Mike, no, that's a whole nother subject. That's stuff we teach now, and that would be, we wouldn't have time for that. Interference, we'll get to that, Boyke. Thank you. We'll get to what interference is next. Here's using momentum to determine strength, and correlations are all about strength and weakness, right? Here's two markets we're looking at. You have the dollar yen on the left and Aussie yen on the right. Let's say at the beginning of the year, you don't know which one to go long. But you think maybe this is the year that dollar yen finally turns around, that Aussie yen finally turns around. So at the beginning of the year, you have a choice about going long Aussie yen or dollar yen, and you're not sure which way you want to go. Well, we would say take a look at momentum on the chart, the MACD. A couple things. Aussie dollar you already have a built-in advantage in the Aussie dollar. You have a bullish pattern, right? You have a pattern of higher lows, right? Here, yeah, you kind of have higher lows, not as pronounced. But you do have higher lows in dollar yen. You have pronounced higher lows in Aussie yen. But look at the momentum at the beginning of the year. That momentum's not bad at all. That momentum is kind of crappy, right? So another way to determine coming strength, which market's going to be stronger in the future, which one's going to be weaker, is definitely the momentum to it. Momentum is beautiful. It's a beautiful thing. Boyke might come back next week for that. So again, advantage Aussie yen because it had the charts helping you out here. The momentum is definitely momentum is a sign of strength. That's how we measure strength and weakness in the markets. The MACD or the RSI or any garden variety momentum indicator. From my perspective, in my book, they're all the same. It's just momentum. So you got to use that. You got to use the momentum to your advantage too. And here, that's just showing you in the first 2 months you'd have made 336 pips here in the yen. You'd have made almost 800 pips in the Aussie. Kind of a no-brainer. I'm going to get to the charts too and show you what's happening in the markets there. I think I always feel I'm going to lose you when we're on the slideshow. When strength and weakness are deceptive. Oh, this is very important to know too. This is the other side of it. It's easy to give you examples of markets are strong, but you have to know when to fade momentum too. Oh, Phil was just mentioning that. A lot of professional traders know when to fade it too. Exactly. Here's two things. Old saying. Every old trader knows this. If you still have gray hair and you made it that far, you're still in the game. You know the market with the most shorts produces the fastest rallies. The market with the most longs produces the most violent sell-offs. Here's when you have to learn how to fade momentum. Once you understand that, you'll start to understand the character of market corrections. They're very difficult to predict when they're going to come, but we know over time they always come, right? So really, you'll know why you want to wait for trend line breaks to occur first before you focus on when to trade. I look forward to a trend line break because inevitably you get a trend line break, everyone thinks you're having a reversal, so momentum picks up. Momentum picks up when you get a trend line break. If that trend line break, if it was a true trend line and it was a trend line break, that means the market's going counter trend, right? You get very fast, very strong counter trend movement, but guess what? It's counter trend. It's against the long-term trend, so that's when you have to know when to fade that, right? So when everyone else is weighing whether the correction is actually a reversal and it's going down, it's down 38%, down 50%, down 67%, everyone else is thinking it's a reversal, you're thinking, well, it could just be a momentum blip, and that's how counter trend moves are. More times than not, those big, fast, hard moves tend to be counter trend moves. Look at all the sell-offs in the summer in the stock market the last couple of years. Look at the nature of those, very fast, very quick. Well, they were just counter trend moves. But they did their job. They got people scared. They shook people out of positions, and that's how markets do it. So always know this. The market with the most shorts produces the fastest rallies. The market with the most longs produces the most violent sell-offs. And I think actually the last month has been a great example. The last 2 months have been a great example of this in the euro and the Aussie too. The euro had the most amount of shorts, gave you the biggest rally. Aussie had the most amount of longs, so it was soft. It was weak. Because if everyone's long, then all they can do is sell, right? So if everyone's long the market already, that's a bit of a bearish development. And if too many people are long it, that's a bearish development too, because as people get scared, they're going to come out of there. Absolutely. If too many people are long and they get scared, you're going to get a correction. And that's what corrections are, fear. So that's a good time to be able to know when to fade those. Here's a great example of it. And it's funny, this is an old chart. I put this lesson together a long time ago. But here's a great example of when to fade strength. The pattern itself is still bearish, right? A little kid looking at a chart, and his first lesson in technical analysis can look at this daily chart here and think, I'd rather be a seller here than a buyer, right? Look, the overall pattern, I just draw my trend line. I could see a pattern of lower highs here. I have lower highs and lower lows. So lower highs, lower lows, that's a trend. I want to sell a rally. I want to get short after a rally. I want to sell a rally. I want to sell strength, basically. So this is when you sell strength in an overall downtrend. So look at it. It wasn't up there long either, was it? Excuse me. So professional traders knew to fade this momentum. Look at the momentum in there. At one point, it's like straight up. Look at that. So that is when you need to know when to fade that. Day-to-day markets, you want to be buying dips in the stronger market, selling rallies in the weaker market. But there does come times when you get climactic price movement after a short squeeze or a long liquidation, such as there, that you got to know when to fade it. Here, let me read the notes now. Tell the stories about momentum. Okay, you guys are just having fun going back and forth there. So you have to know when to fade strength, and that was one of those opportunities to do it right there. When weakness is deceptive too. Weakness definitely can be deceptive in an asset class market. When you have a panic in the market, essentially, when you have those panics, smart money, William the Fractal, well, he's not even smart. He doesn't know anything. William the Fractal and all the working people, their 401ks are set on automatic. Whatever asset class markets they decide to buy, they're going to buy them automatically. So people who have money and make money love market corrections because it's an opportunity to get more on the way down. You're going to dollar cost average. So when weakness is deceptive, is in a market's healthier overall, and you're just seeing a correction, and everyone panics out, and the smarter people or the more wealthy people just step up and buy more. There's an old story how the people on Fifth Avenue approach stock markets. The people on Fifth Avenue in New York, or the people that live on Central Park that have their homes are worth so much money, they wait until there's a headline that the market crashed. Then they take all their cash laying around, not their investments, and all the cash they have laying around the house, they go buy as much stocks as they can carry every time there's a headline that says the market crashed, right? Then they wait until the headlines are talking about buy more and everything's going great, and then they come and they get out of it. So basically, their signal to buy is when the newspaper is saying the market crashed and there's blood in the streets. Basically, it's back to Rothschild saying buy when there's blood in the streets and sell when euphoric. So who's that guy that he wrote a book through McGraw-Hill? He's the bear. He was a professor of some sort. And he got lucky. He wrote a book and he called The Crash of '08 or something like that. Nouriel Roubini? Yeah, when Roubini finally figures it all out, then that's the time you want to sell it. But otherwise, it just keeps going higher. Okay, so that's when weakness can be deceptive. For the most part, anytime you see a hard, fast correction, that's the time that you want to be focusing on when to buy. And if given the overall pattern is bullish too, and always use stops too. I mean, it's realistic that if you're trading, you wanna definitely be using stops. Investing, that's a different area. So interference, positive interference and negative interference. This is great. I made it so far. I really haven't seen any typos yet. So interference, here's what we're going to demonstrate for you. Positive interference, we've borrowed from physics in describing the effects of when two or more markets are moving in harmony or moving divergent to one another. Okay, they're moving in harmony. If you take two coins of the same size from the same height at the same time and drop them into a pond, the waves created by that energy will be coordinated, and the resulting waves would converge, effectively doubling the size of the waves as they spread across the pond. Got that? Take two stones, two coins, same size, drop them at the same time. They're going to drop at the same speed. They're going to hit the pond together. Their waves are going to converge and make a wave that's going to be twice as big, right? In physics, this is called constructive interference or harmonic resonance. So constructive interference or harmonics, when the coins hit at the same time, the waves double. On the other hand, if the waves hit at different times or at different sizes, the resulting effect is going to be what we call destructive interference, and the waves will be divergent to each other. So in the other example, the waves were convergent. When you have convergent waves, you have big waves. When you have divergent waves, the waves effectively cancel each other out. Markets do the same thing when they're moving together. The convergences create larger moves, but when they're moving out of sync or divergent, the resulting energy tends to fizzle out and counter-trending price movement follows. That's why we always say you're better off going walking the dog or watering the garden or something else, go fishing when you're in counter-trending markets. Now, I'm not a scientist, so I've opted for these terms positive interference to describe when signals are related. Positive interference to describe when signals are related in related markets are coordinated, and negative interference to describe when signals are divergent. In science, in physics, it's called destructive interference. We're calling it positive or negative interference. So that's where those terms came up with. The thing to remember is when you want to be seeing positive interference when you're trading, not negative interference. You want everything moving together. And I actually have an article on the blog about this. Let me see if I can give it to you guys. See if that's it. And that may help you too. But that's the definition of the two interferences. Here's a good example of negative interference. Negative interference is when the pebbles are hitting the pond at different times, or one's pebbles larger than the other. Here's an example in trading. You want to take this. You got the euro yen on the left, euro on the right. Okay, euro on the right, euro yen on the left. When you get the buy signal in the euro right here, you get a change of direction here. And also look at your MACD showing you divergence too. So actually the momentum shows you're bottoming. You have a change of direction right there. You have a trend line break and you have a change of direction. But you come over here at the same time to your cousin euro yen, and euro yen, you know what's cool about euro yen is you don't have a change of interference. You're still below the trend line. Here you climbed above a trend line, you had divergence, you're tempted to buy. Here you don't have a change of direction. You don't have divergence in between the MACD, so the momentum is down. Direction is still down. If you're considering a buy signal here, it may be in your best interest to say, I'm going to wait for this related market to wait till it's giving a buy signal also. If you wait, now if you go long here with a stop below the low on the euro on the right, if you go long there, you put a stop below that low, you're going to get stopped out. No problem. You have to go back in again, and you'll get it again. But you're going to be better from the start to go back in here on the next slide. You wait till both of them are giving the signal. You wait till both of them have a bullish change of direction, and you have the benefit of momentum now Now the timing here is a lot better. You don't go long here, get stopped out here, have to go long there again. You're just going long here. And that's when the move comes. So you had positive interference when both markets are signaling together. You had negative interference when the euro was pulling one way and the Aussie yen wasn't ready to go yet. So that's positive interference. Hopefully I have an example of negative interference. Oh, here, let me go to the live charts to give you some examples here. And, you know, relationships are so important. And I think probably one of the reasons that FX Street asked us to do these webinars on the relationships because they really have changed significantly. This is an hourly chart. Hourly charts you're looking at. And you can really see how these markets used to essentially be in sync. Here, let me show you the stock market and the euro. Here you see they're in sync today. Look at the stock market. Whatever the stocks are doing, whatever the stocks do, the euro follows for the most part. Euro here and E-mini S&P here. So there you see the correlations are pretty powerful. You don't even see it in the Aussie. Right here, we're actually looking for a double top in that euro. Do we even get it? See, we want to see it get up here and give us. That's another story though. Back online here. So the correlations they're definitely not there like they used to be in the Aussie and the here we can go to let's go to a weekly chart. And this is why, you know, this will throw off traders if you're betting on correlations in your trading. If your trading plan considers correlations, then you may be in trouble now because you're seeing correlations break down here. You can see these are both weekly charts, and boy, look at this. The euro is going down and the Aussie is going sideways. So you can't count on those correlations like you used to be able to. Here's the big one. You see the primary pattern is down here in the euro. Weekly primary down, primary's up in the Aussie. So you definitely have definitely a longer term convergence to the way it used to be, right? When they used to, you know, back in the old days, they all did the same thing together, right? They pretty much went up and down in sync, and people came to count on that. Now you don't really see that anymore. You can see it started to change in the QE era. And it changed in the QE era because all the money went to the Aussie because you have a yield there, right? So you have the yield in the Aussie, and it comes back to, you know, it comes back to how, you know, people with money, who have money and make money, approach markets. You can see a breakdown in the correlation now. This market's holding its own because there's tons of money coming in at every payday. This market's quite a bit weaker. But I will show you this. These correlations, the longer term, the obvious long-term correlations break down. However, there's always a connection. Markets always shift at the same time, for the most part. I mean, not even for the most part. They still do it in an intraday basis. They shift at the same time. One may shift and give you an impulse move, and the other will give you a counter trend move. But they're always going to shift at that same time. So they still, on an intraday basis, they still follow each other very closely. You can see the correlations here. S&P on the left, Euro on the right here. And you can see how tightly correlated they are. Now, here's the Aussie and the Euro. They may not look as tightly correlated, but they still shift at the same time. I'm trying to get the equal amount of time on each chart there so you can see they still shift at the same time. For example, you know, this may be in a downtrend. The Aussie may be sideways and the Euro may be in a downtrend, but they're still going to shift at the same time. So when you see this guy shifting up, that's telling you if the Aussie's shifting up, you don't want to be going short the Euro. So right here, when the Aussie's shifting up, you don't want to be getting short that Euro. Likewise, when your Aussie's shifting up here, you don't want to be short the Euro here. So you're still going to get the biggest moves when they're all moving together. So be mindful that long term the correlations aren't what they used to be. Shorter term though, they definitely still give signals at the same time. So all things being equal, if you're considering a sell signal in the euro, you want to see that you're getting a sell signal in the Aussie. You don't want to be considering a sell signal here and you're getting a buy signal in the other guy, the euro. They're generally good. Not even generally. They still change direction at the same time, but one will give a counter trend move while one will give a rip-roaring trend move. So they still turn at the same time. That'll always be the case. So you have to be aware of that. You want to be getting signals at the same time. You're still going to get bigger trades because you're going to get positive interference when the markets are triggering at the same time. Even better if they share patterns. They don't have to share patterns, but they will still trigger at the same time. Ideally, they'll find markets that share patterns and they're triggering at the same time. Then you'll find big trades. You'll find bigger, longer-term trades. So this is something that you can imagine we spent a little bit of time covering at Trading University. We spent a lot more time, however, on pattern recognition, trade selection, trade management. But I'm glad they offered us the opportunity to cover this subject because it is a big subject. You want to know if you have constructive interference or negative interference because you don't want to be taking signals in the market you're following if that market's out of sync with the other markets. Yeah, I apologize. Boyke, he's talking about my lingo, my accent. I think the girls at FX Street are fantastic that they can understand me because their English is not their second or even third language, I suspect. They know English, but I don't know. I can't speak French or anything, but somehow they get everything done. They seem to know what I'm talking about. So I'm always amazed at the girls at FX Street that they can understand me too, and you guys too. I thank you for being patient. But that's why I have books, and we have the courses too. I go a lot slower in the courses, by the way, and you can slow me down to ask questions too. But yeah, if you want to know more about what we're doing, come in and click on our market commentary section. You can go to our YouTube page from there. You have our Seeking Alpha blog. We have a couple of blogs on there and the videos. So go to trading-u.com, go to our market commentary section, and we've got hundreds of a library with hundreds of examples of articles, all that good stuff. Our weekly and our midweek and weekly reports, so you can see how we've called markets in the past. We do a lot of market forecasting on there, so that gives you a good idea that we kind of know how markets move. Next book, don't ask, Boyke. I started an e-book because I just want to consolidate everything and make it more clear and more to the point, too, more the tip of the iceberg stuff. And, that's work, though. Keep in mind, me having to write a book, it's work. And you know what's great about McGraw-Hill? I always appreciated McGraw-Hill's editors. You had 4 or 5 different editors going over that thing with a fine-tooth comb, making sure there's no, oh, no, she won't. No, the wife. No. I've worked her to death these last couple of years. No, she's not going to work. No, unless you pay her. If you pay her a lot, then the wife can assist. But you got to write the book. You got to edit the book. Now, I'm going to do it, though. But it's not going to, it's maybe half done, but there's half written is not half done because you got to come up with an index, and it's a ton of work, and it really needs to be professionally edited and all that stuff. So she cooks all the time. Yeah. No, she does, Boyke. She's great. She brings me food all the time. I'd be in the gutter without my wife. I'm telling you, when I was a young man, I always had to throw the dice. I'm always trying to figure out how to make a dime out of a nickel. Never had much, but no, life's great though. So she's a saint, yeah. But come to the website and click on the market commentary, and there's all kinds of good educational stuff there. If you have specific questions about the courses, we'd love to field those. Skype me directly, and I'll have you on my screen, and we can look at whatever market you're looking at and you're interested in doing. We could talk about that, and we could show you how our method would apply to that. Thank you, Boyke. Thank you, sir. She cooks. Oh, yeah, she cooks. Doesn't edit, though. Not going to edit. Hey, thank you so much. It was great to see everybody. I like the new format. You click and go, right? You click on there, much easier to log in. So we'll see you guys next Tuesday on FX Street, and we'll see some of you guys if you sign up for our live market analysis this Friday, where we if you want to go to the site under Education and click on Live Market Analysis, come and sign up, and you can come on my screen for a couple hours on Friday in live markets, and we'll demonstrate what we do. Thank you guys so much.